Welcome to the Trading Script, Markets in Motion, where we discuss and analyze the markets every day, including trading strategies and how to react to certain market events. Today, we analyze what happened on Monday, August 5, known by some as Black Monday. Was it really a surprise? Wasn't any warning at all in the markets? This is what we are here to discuss. We are going to look at some charts and, most importantly, at some indicators that were actually warning us about this sell-off that we experienced in the market. Moreover, we are going to use this same indicators and strategies to discover what we can expect from the markets in the weeks ahead. Let's start, of course, by looking at the daily chart of the S&P 500. And let's quickly go over some of the indicators that we have in place. Some of these you may already be familiar with, and some others you will have to learn how to use. And if you are completely new to technical analysis, don't worry. I promise that we will get you up to speed, no problem. The point of technical analysis, however, is not to pretend that we have a crystal ball, but to assess the chances of something happening in the market and prepare or react accordingly. Also worth mentioning is that technical analysis, at least as we do it on this channel, doesn't limit to just looking at one chart and trying to guess what's going to happen. We will look at multiple charts and multiple assets to try to determine future market behavior. This is what we call looking for divergences in the market. For example, right off the bat, if we compare this chart of the S&P 500 to the one of the NASDAQ, we can see there's a clear divergence. We have an almost equal top on the S&P 500 and a lower high on the NASDAQ, which quite simply means that the market isn't happy. Not everything is okay out there. There is doubt, there is fear. Not every trade is a good trade. Not every stock is a good stock. And if this sounds way too simple, well, we have to acknowledge that many times the market can be extremely difficult, but that sometimes it can be quite simple, at least to some extent. So if we continue to dig deeper, let's say into the SMH chart, which is the chart for semiconductors, we can also find this same divergence. In a healthy market, a happy market, these divergences are almost never present, meaning that there's a certain level of synchronization across the board. But going back to the chart of the S&P 500, and to the indicators that we mentioned, what we have here is what is known as exponential moving averages, which, to put it in simple terms, tracks the current changes in the price of a stock or asset over time. These are probably the most common type of technical indicators, but still quite useful. Simply put, if the price is above the moving averages, it means that we are in an uptrend and prices should go higher. And if it is below them, we should expect lower prices. Very simple indeed. So how does this relate to what we saw this past 5th of August? Could we really have used something so simple to predict a market pullback, or at least to expect one to some extent? Well, let's look at another very popular chart, the VIX, also known as the fear gauge. Just by taking a quick look at it, this is again the daily chart, we can see that starting on July 18th, the VIX broke out for the first time in a while above all these moving averages. Of course, there's significance regarding the order of these moving averages, but for now, let's keep it simple and understand that as long as the VIX stays above these, we can consider the VIX itself to be in an uptrend, meaning that in the days ahead, at least until proven otherwise, we can expect the VIX to go higher. And what is that proof, you may ask? Well, that's simply the VIX breaking below these moving averages and staying there. Again, this is very simple technical analysis, but for now, this is telling us that we should be cautious when taking long positions. However, this isn't everything we can use these indicators for. We can also use them to determine when we may have a potential bottom, at least in the short term, in the market. Going back to the chart of the S&P 500, we can see that we are close to tagging the 100 exponential moving average, which may trigger a reversal or a bounce in the market. Nevertheless, and this is when what we mentioned regarding synchronization comes into play, if we look at the S&P 500 futures chart, we can see that this has already broken below the same moving average. Again, if we pay attention to multiple other iterations in the market, we can see that most of the time, both these charts are in synchronization. And in a healthy market environment, this type of synchronization happens across almost any other asset or index. Of course, this lack of synchronization isn't always a bad thing. Many times, when the market is falling or in a correction, we can find assets that may have already begun to change their trend. This is what we call a positive divergence, and that we can use to spot market recoveries. As of now, the market is quite simply warning us that although there might be some bounces, more downside remains ahead until we recover this synchronization across multiple assets or we start to find some positive divergences. And when we do, we will, of course, let you know on this channel. Now, how about the fundamental aspect of all this? Well, we have a lot going on. We have, of course, the upcoming presidential debate, inflation data coming in next week, and later this month, the very important Fed interest rate decision. Will they cut? And if so, by how much? All that, of course, is still up in the air. For now, though, by looking at the charts, we can at least have an idea of where the market wants to go. Of course, there are many other indicators that we are looking at right now, and that will warn us of a potential change in market sentiment, but we'll discuss those in future videos. So remember, take a very close look at the VIX, since right now the gates are open for a more significant pullback in the upcoming days and weeks, and any rally should be looked at with skepticism. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos regarding market and technical analysis.